all I have to say about gold and silver is that you need to hold on to your gold and silver for dear life because the markets are very volatile. And it's not people selling their physical gold and silver. Here's speculators selling the futures, right, to pay margin on their other holdings, which are getting hammered.
Once we get some sort of stability, then we'll see what rises from the ashes first. And I think that gold and silver should do quite well because of the prospect of this inflationary environment coupled with recession where it's not good to invest in anything except something which is going to keep pace with inflation.
The big bank revised its gold forecasts and price predictions upwards after the strong rally at the beginning of the year. Gold has surged past $5,600 per ounce for the first time ever at the beginning of 2026, signaling strong investor demand beyond typical rate or dollar movements. This milestone reflects a fundamental shift in investor sentiment and global capital flows toward tangible assets amid geopolitical and economic uncertainties. Financial market commentator and analyst MarioInnecco and Clive Thompson provide insights on global markets and the outlook for precious metals. MarioInnecco says the recent surge in WTI crude oil and Brent crude has raised inflation fears, but he argues that inflation is actually caused by governments and central banks expanding money and credit through borrowing and currency creation. As governments ramp up spending to fund conflict, they inevitably turn to currency creation and borrowing, hence triggering systemic debasement. Innecco argues that this makes gold and silver more than just assets. They are essential hedges against the erosion of purchasing power. Regarding the recent dip in precious metals, Innecco argues it's a liquidity crunch. The decline is being driven by speculative selling in the futures markets. As stock market volatility spikes, investors are being forced to liquidate their winning gold and silver positions just to meet margin calls and raise immediate cash. It's a mechanical sell-off, not a fundamental one. Despite this short-term noise, Innecco's long-term conviction is unshakable. He points to the triple threat of exploding government debt, surging bond yields, and the accelerating global move away from the dollar. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from MarioInnecco and Clive Thompson's recent interview.
Overnight, the big thing really people are going to talk about today is crude oil. They're going to focus on crude oil. They're going to say that the price of oil is going to cause inflation, which is complete to utter nonsense because you should know by now that only governments can create inflation, right? And how do they do that? Well, through their central banks and through borrowing, they create credit out of thin air, and they create currency out of thin air, and they crowd out the private sector, and they buy assets, they buy goods and services, and you get the currency once it's already devalued, right? That's the what's that called? I forgot now. The economist from the 1700s said that, you get the currency when it's devalued, and that's going to continue because wars are expensive, destructive, and we always end up paying for it. Here in the UK, I think up until recently, we're still paying for Napoleonic War debts. In the US, people are still paying for World War I and World War II debts. Yes, those debts have been inflated away. So that's another way, another reason why you should have gold and silver, because in the long term, you can bet the government, Congress, the central bank, Parliament, wherever you are, and I'm not slagging off just the United States because Europe has been a master at this, they're going to rip you off, and the very wealthy who have the assets, they'll continue to be wealthy, right? And it's one of the reasons why I keep harping on about gold and silver, because if you have some, you might be able to protect your family somewhat from the scourge of war, right? And wars, really, the worst part of wars are after the war, when you really have to pay for it. So yeah, WTI crude today got up to 115.78. Right now it's at 100. I see here that they're talking about G7 to discuss joint release of emergency oil reserves. So is that going to help short term as usual? What about Brent crude? Well, Brent crude traded up to 116.28. Right now it's at 104.58. What about gold and silver? Well, all I have to say about gold and silver is that you need to hold on to your gold and silver for dear life because the markets are very volatile, and it's not people selling their physical gold and silver. Here's speculators selling the futures, right, to pay margin on their other holdings, which are getting hammered today, like the Dow futures, for example. Right now is down 700 points, but it's been down as much as 1,200 points. So it's all over the shop. It has rebounded since oil has come back down. The NASDAQ 100 future is down 1.5% as well, or 360 points. But it was down as much as 700 roughly. And the S&P as well, same thing. It's at down 88, and it's been down as much as, let's see, 150 points. More than double what it's down now. What about gold and silver? Yes, they were sold off, gold and silver futures. Spot gold got down to 5,013. We're now around 5,100, down about 1.4%. So gold is down as much as the stock market. Silver is down actually just 1% at 83.60. So silver is doing relatively well. So the gold-silver ratio is actually dropping slightly. And the more important market, which very few people will look at, of course, because it's where the smart money is, right, is the government bond market. Well, the Treasury yield curve continues to go up. Yields continue to go up, which is a bad thing. Don't forget, the United States has 9 trillion, well, it's already started rolling over 9 trillion this year of old debt that they need to roll over. I think it's going to get harder and harder, not just because the cost of this war and the cost of all the destruction of its military infrastructure in the Middle East and its allies, but also because it's going to convince more and more countries, even allies, that it might not be a good idea to lend too much money to Uncle Sam, not just because it might come back to haunt them in that you're financing the institution that's coming after you, right? Well, you know, and it's reasonable to say that because President Trump talked about Greenland. That's an ally, right? So, but not just allies, but countries that are not aligned with the U.S., I'm sure they're going to think really hard about increasing their treasury holdings. So it's going to become harder and harder. The world is going to de-dollarize more and more. And countries like Japan and South Korea, they are very dependent on oil from the Middle East. Their stock markets have been hammered today. And I think they might have to sell a lot of their dollar reserves to cover the cost of oil going up so much. Ever since this war started, the 10-year yield has been going higher and higher. It was below 4%, and now we're at 4.20, up 5 basis points, and I think it's going to continue, unfortunately, for you, the taxpayer, for you who's not in the top 1%, right? I think it's going to get harder and harder. How do you cope with that? Well, I think the first most important thing is that you know what's happening. Don't buy into this mantra narrative that I hear now, that all of this is short-term pain for the long-term gain, right? Because, don't get fooled by that. Do what you need to do to help yourself, and don't listen to to these people who start the wars.
Clive Thompson warns that the Federal Reserve is officially trapped. As unemployment climbs, the Fed will be forced to keep interest rates low even as inflation remains sticky. This creates the ultimate catalyst for precious metals. When the interest you earn on cash is lower than the rate of inflation, holding paper becomes a guaranteed loss. Thompson predicts that as the recession deepens, the traditional 60-40 portfolio will fail, forcing investors to abandon both cratering equities and worthless bonds. In this environment, gold and silver aren't just alternatives, they become the only viable exit ramp for capital preservation. Central banks keep snapping up gold, Trump's trade wars rage on, geopolitical tensions stay high, ETF holdings expand steadily, and Fed rate cut hopes grow stronger, all pointing to this bull run having plenty of room left, with gold prices forecasted to trade around $5,000 per ounce in 2026. Looking ahead, Thompson predicts that once market stability returns, the combination of recession risks and persistent inflation could push investors back toward precious metals, potentially supporting higher prices over the coming months. Let's jump into the interview.
If inflation rises, as seems likely, and interest rates don't go up, as seems likely, because of the rising unemployment, then we could end up in a situation where the real yield goes negative. Now, if that happens, that's a very bullish scenario for gold because people won't be going into equities in a recession because profits will be falling. They won't be going into bonds because inflation's rising. So where do they go? They're going to go to the precious metals market. This morning, look at the prices. We'll have a look at the charts in a second or two. I saw gold had dropped to $5,050, down 2.5%, I think it was something like that. Now the dollar index, the DXY, has risen overnight by about 0.5% or more. I also saw that various stock markets, the Asian markets, were down very sharply. The European markets are opening up this morning. They are looking like they are opening down more than 2% lower. In Japan, the index was down at, when I last looked, 5.2%. The Korean Kospi index was 6% down, but was stopped due to a circuit breaker. Bond yields are on the up, unusual in a recession, but that's showing that the bond markets are concentrating more on the inflationary risk than they are on the recession fears. That's unusual and potentially dangerous. President Trump has said that the oil price strike is a very small price to pay for getting rid of Iran's nuclear ambitions, but there are certain cracks starting to appear in the Republican Party. Now, the Energy Secretary of the USA says that they're not targeting Iran's energy infrastructure, but overnight there's been quite a few attacks on infrastructure. We don't know where they're coming from necessarily. Other Gulf states are being dragged into the crossfire. A number of drones have been intercepted over countries like Kuwait, Saudi Arabia, Bahrain, United Arab Emirates. So no damage, but the fact is that the drones, presumably coming from Iran, are overflying these countries. In the UK, the RAF bases have been confirmed that they can be used as support for the United States, including support which might involve strikes on Iran. Emerging markets, the energy importers, the ones who need energy to make their manufactured goods, are the biggest sufferers. Let's have a look at gold now this morning. So we'll go to the gold price. So it's recovered a little bit. I saw 50.50 earlier today. It's now down $79 at 5,089, and silver, which is 1.59% down. Silver's down 1.22% at 83.43. Now, when prices of equities are falling and other things are falling, it's only normal that gold and silver should get carried down with it. People are getting margin calls. There's obviously going to be plenty of leveraged people out there. They'll be getting margin calls, and you must expect in the early stages that everything will fall. Of course, once we get some sort of stability, then we'll see what rises from the ashes first, and I think that gold and silver should do quite well because of the prospect of this inflationary environment coupled with recession where it's not good to invest in anything except something which is going to keep pace with inflation. Of course, you can look at US TIPS, that's Treasury Inflation Protected Securities. I haven't looked at them myself, so I can't tell you if they're good, but it's something that perhaps people are looking at the moment. The GDX and GDXJ, the two exchange-traded funds which track mining shares, gold mining shares and junior gold mining shares, they are both down and will fall heavily when the market opens tonight. The reason for that is people having to raise cash, and they raise cash wherever they can, and these two indices are well up on a year ago, so it's quite normal people sell their most profitable positions first, so they try and keep some of their profit. So it's hard to say that we're in an environment where these things are going to jump tomorrow. I don't think that's the case, but if you're not a nervous Nelly, you can hang on to them, and we'll see in a month or two, in the next few months, the next 6 months, 9 months, we'll see much higher profits reported by these mining companies due to the fact that the average gold price in the fourth quarter of 2025 was much higher than the third quarter, which is the one already reported, and due to the fact the gold and silver prices in the first quarter of 2026 are higher still. So what does that mean? It means that probably we will see, after we've had the decline, and we're going to have a decline, there's no messing up, it probably means that the prices will start to come back as these higher profits.
A softening U.S. dollar, rising expectations for Federal Reserve rate cuts, and persistent geopolitical risk have all reinforced gold's appeal as a safe haven asset, while a broader retreat from dollar-denominated instruments has pushed sovereign buyers toward hard assets at an accelerating pace. With both metals now in flux and economic uncertainty still running high, investors are weighing their next move. Where will prices head next, though? And should you have gold or silver on your investing agenda this March? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.